Hey guys, welcome to another Trade Genius podcast. We've hit the debt ceiling today. That means the government can't borrow any more money. Is this bullish or bearish for the markets? We're going to tell you in this video. Stay tuned.
Trade Genius.
Hey, Phil, before we get to that, I know there were some questions that we do to follow up on the Bank of Japan announcement. Could you throw that chart up and kind of walk people through what happened and what to look for?
Yeah, so if you guys notice, the yen is basically in a pretty strong uptrend. This is the yen future. So this is the 6J one. You can plot that on your trading view charts. And our belief is that as long as this holds this uptrend, markets are probably going to be stable. However, if it falls out, it's probably going to coincide with these yields trying to jack back up to that 0.5 cap. Remember, if it goes over 0.5, they're going to be burning a lot of yen to try to keep their bond market stable. So, without getting too technical, they basically just announced that they were going to support their bond market even more. And so it kind of caught those who are short the bonds. So if you're short the bonds, it drives the yields up. Those guys got creamed, so those guys had to cover their shorts and their bond yields dropped. So as long as this stays under 0.5 and the yen's able to hold that uptrend, I think that bodes well for the market. So we were warning about them being hawkish. They didn't pull the trigger on that. So I think overall the market's got to pass, even though we've pulled back some, and we'll get into that a little bit more later. The big worry about them being hawkish didn't happen. So we're okay on that front for now.
Yeah, hey, thanks for that, Phil. And just because the yen thing didn't make Armageddon happen with the markets, there are a lot of cross currents in the market, and the market can go either way. And now we just added another variable to this conversation, and I'll kind of kick this off, Phil, and I'll get your thoughts on it. I think we hit it on Thursday. We hit the limit where the federal government can no longer borrow any more money.
Right.
And so now you hear a whole lot of stuff like, oh, catastrophe, extraordinary. Look, we've been through this, I think, 180 times or some crazy number already since they put this law into place. And all it means is the government can't borrow any more money. It doesn't mean the government doesn't have any more money. And I think Phil's going to show a chart here in a minute to show you that Janet Yellen has a stash. I'll let him explain it. And she's been using that stash for political purposes for quite some time. And that stash could be used to manipulate the stock market. So that, Phil, I'm going to throw it back over to you and kind of explain that chart, and then we could talk implications.
Yeah, so like you said, it's not like we're out of money. That probably doesn't become an issue till we get into June or July. And then at that point, we come to a head for all this. But for right now, we've got over 300 billion in the Treasury coffers. And if you'll notice on the chart there, we kind of peaked out just before we got into May. And then they started spending money, or money was outflowing from, think of this as the checking account for the Treasury, okay? If that line is going down, meaning they're spending money, that ultimately ends up going back into the markets as a form of liquidity. So that helps the markets. And it actually is fighting the Fed as the Fed is trying to pull liquidity out of the market. So if you look back from June, we've kind of more or less gone sideways. I mean, yes, we've gyrated several hundred points, but on net, if you look at the median price range in the middle there, we really haven't gone much of anywhere. And that's because this decline in the Treasury has been fighting the Fed's efforts to remove liquidity, incentivize the banks to park money outside of the stock market and try to get these asset prices down. And that plays into the seasonality. For those of you that are newer subscribers, we've talked about the seasonality in the markets and going into midterms or a second-year Democratic president midterm. These things have specific seasonalities to them. And part of that is, they will start spending money out of the Treasury to get money flowing back into the markets to make everything look good going into those elections. And they'll do it again going into the presidential election as well. So you'll have a bump going from summertime into the end of the year. And so, you have to be aware of these things. But to Bob's point, she's been fighting the Fed here and putting more money in. Now, will she have to kind of pull back and watch what she does because they don't really have the ability to borrow anymore? That remains to be seen. We just have to keep an eye on this and kind of update you guys and to see whether this line is going up or down. Basically, we get updates every week on it, but that is going to be a key component into whether or not these markets have more juice available to them to go up or down.
Yeah, and And the thing people keep in mind is that, and Phil will show you this chart in a little bit too, is that, when she puts this money into the market, she's injecting, basically Yellen juice into the economy, which flows into the stock market. To Phil's point is that, they have the checking account, but they also are getting money in every day. We're pulling money in every day. Every time a payroll is run, money's going into the Treasury.
Right.
They don't bifurcate Social Security or Medicare dollars. Everything gets thrown into one pot.
Right.
And she's going to spend all that money. And then come April and May, we're going to get huge cash injections from people paying their taxes. So, that's why they can limp this thing along to June. And this is where you hear from people saying, this is kind of a form of QE. And when this happens, is that, is there a potential for what we'd call a crack up boom here? We have to be open to that. Even with all the things on the ledger of market weakness, liquidity conquers all, as we've been saying all along here. And she can short term overwhelm everything else and drive the market up higher in the short term. But then she runs out of money and she has to refill those coffers at the same time that she has to borrow again. And then she falls into basically Jerome Powell being in charge again. And so, he may limp this thing along until they get this debt thing solved, in terms of some sort of legislation. And then we could really go from a crack up boom to a pretty strong market weakness. So we just want to kind of point both sides out of this. If there was no debt ceiling happening right now, is that, fundamentals more would take over this market and Powell would have a little bit more power. But they know Yellen's she's gonna jam on the gas here because she has no choice. The government has to pay its bills. So with that, Phil, do you want to talk about the liquidity chart?
Yeah. So to your point, okay. So, if you guys can see the blue here, this is the fuel for the market. Okay, this is what they call the Fed net liquidity, and as it goes, so does the S&P 500 until things change. But things aren't going to change anytime soon. So this is what we run with. And you'll notice that we've had this pretty good drawdown from the beginning of 2022, okay? And we've had a couple waves down on that. But funny thing was, as we got into June and we put in the lows of June, the net liquidity, if you look like this blue area, I mean, if you look at where we are now compared to where we were back in June, we're about the same level, okay? And so is the stock market. And so if Janet Yellen wasn't spending that money, okay, if we go back to that chart, you see how that blue line moved down here, right? So if she wasn't spending that money, getting that money back into the market, then actually we would have seen this drop quite a bit more, and the market probably would be below these lows that we have here now. So we can pretty well say that she's been responsible for propping the market up because the Fed's been reducing their balance sheet, and the reverse repos, which are the banks. Basically, the Fed incentivizes the banks to pull money out of the market and park it in those repos. Those have been going up on net. And both of those actions, the balance sheet going down and the reverse repos going up, are negative for this liquidity for the market. So she's been responsible for fighting that and keeping things propped up. And that's why those levels that we have on that chart for the checking account matter a lot now, because she's the one in the way from whether or not this thing drops further. But you can see that here we've been holding steady, but this is why it's important to watch these charts, and we'll keep you updated from time to time. But if we see a pretty big decline, especially on today's update, and we'll update that in the newsletter, which you guys can go to our website, check that out, tradegenius.co, or click the link in the description below. You can get that because that will update that every day on that newsletter. But if later tonight we're going to get the weekly updates, and if this drops considerably, then that's your big warning that, hey, OPEX is tomorrow. After OPEX, all bets are off. This thing could be heading south. So we won't know until later, but that's what we're keeping our eye on right now. This lower line is fair value. We're getting back to the white line, which is fair value from the markets. And so when we get down to those levels, and again, liquidity will change this. But if we start getting oversold relative to liquidity, we also use this as a measure of whether or not we can buy this dip down here. So these are just some of the tools that we look at, but we thought we would kind of go over the fact that, yeah, we hit the debt limit. There's still money in the system though for us. It's not the end of the world. And really what really matters is this liquidity. And so that's where we're at. So we'll see how this thing develops and talk about it some more as things progress.
So, how I position myself on this, it hasn't really changed for me other than degrees of intensity. And if you noticed with the markets today is that even though the broad market was down and tech was down and small caps were down, energy and gold and silver miners rebounded very quickly. And those are things that I'm watching for, is that people want to get positioned in these commodities. And with the Fed, if China opens and the Fed is not fighting Yellen and Yellen's throwing the gas on and Japan is good, you're going to get probably a short-term bump in all things FANG. And so I'll just kind of stay away from that. But gold and silver and energy will go through the roof. And so that's where I'm playing. And it's been playing well for us since the beginning of 2022. The energy sector does not look like it wants to collapse, no matter how hard they've tried to push this thing down. It keeps wanting to drift higher, and production numbers, we'll probably talk about this next week, is still saying stronger, stronger, stronger. Eventually, it'll get very negative, but that's kind of how I'm positioned on this. So I'm kind of now in both camps. I mean, in one sense, I'm very bearish, but at the other side of it is that if they keep wanting to pay us in commodities, that's where you have to trade.
So yeah, I think we had the gold chart up here while you were talking. That's quite the move off the lows here, and Bitcoin's seen a similar. They're both acting similar here, and Bitcoin or gold at least is getting into a zone of resistance. So if it flips this area, actually, it's kind of a critical spot here. If it flips that to support, you could start looking at attacking this double top here up at 2081.
And Phil, the other thing I've noticed too, and this isn't my idea, I just somebody brought it to my attention. I'm like, wow. So as the bond yields have been falling, tech has been getting a bid, and so keep an eye on that too. We're trying to help you guys see correlations, and if you think CNBC helps you or market fundamentals or earnings, throw it all out the window. The tail that wags this dog is all behind the scenes. It's Fed liquidity and it's options driven. And so those are the things you got to watch. You got to watch the bond market, you got to watch the liquidity market, and you got to watch the open interest on options. And that'll tell you everything you need to know about whether this market's going to go up or down. Yep. And it has served us well, and we're going to continue to do that.
Yep. I mean, it's pretty stark there on that liquidity chart. Just it's like it is the main driver, the fuel of this market. And when you get these areas like this, and back in August when we got overbought relative to it, and that's where this fair value comes in. These are really awesome indicators to let you know, hey, this thing's over its skis, and sure enough, we're back down, because ultimately they're not letting liquidity. If you guys realize, we're going down on liquidity, but we might hold pat, but we're not going back up, and that's by design. And until this market and inflation is to a point where the Fed, I think, is satisfied, the Fed will then open the spigot back up and we'll come back up. So Bob's not lying. This is exactly what it is. Everything else, even all that stuff about accounting and fundamentals, it's just almost meaningless right now in this current market regime, which is pretty wild.
Yep, wag the dog.
Yeah.
Anyway, right. Phil, thanks. Hey guys, like and subscribe and notify and notifications and share with people. We're starting to get more and more people watching the show, and we hope that we're providing a value that you can monetize. And so share it with your friends, and help us reach more people. And at the end of the day, trading's a win-win. I don't have to win, and you have to lose. We all can win together here if we're all looking at the right information.
Absolutely. All right. See you guys later on the next video. Bye.
Trade Genius.